Okay. I think I have most of the people here. We can actually make a gentle start. And hello, everybody. So great to be able to see you. Yeah, so we're gonna have a great time today. Can you all hear me? If you can, please just have a message in the comment sections, and I'm sure my colleague Brian should be able to relay that to me. Yeah, excellent. So I think we're gonna have a great time today. So great 90 minutes together. Yeah. But I want to start by one key question for you. So what do you think is the biggest challenge in structuring debts for project finance? Got a lot of you may be developing project yourself or know people developing projects, or you want to find a little bit more. And you know that when you're developing project, it's very difficult to have all the money just from equity, right? Usually a big chunk of that is coming from the debt. Now, as you're talking about that, so how do you actually properly size it? How do you make it happen? This is what we wanted to have a session today to really address this point, yeah, so that we can all really understand that. So, and that's what we going to be doing. Yep. So, determining the debt capacity, mastering repayment structure, or something else. Think about that as we're going through the webinar together. So, morning, everybody, afternoon, depending where you're joining from, and welcome to the webinar. So, mastering debt sizing, looking at the technique for structuring project finance debt. So, I am Tony T. I'm the founder here of Renewables in Africa. So, if you're here, you most likely would have heard about me already. So, what we do, very simple. We raise awareness about renewables energy in Africa, but also across the globe, right? And if you're looking to raise profile, visibility about the product or service that you're doing, reach out to the right qualified audience, and also make some great sales, definitely you want to be reaching out to us, and then would like to have a conversation with you. And I'll be honored to be the moderator for this insightful session. So as I say, so debt sizing is really the cornerstone for successful project finance. And what we uncover today is some of the techniques. We can't do everything today, let's be honest, but just an idea for you to get a sense of where it's going. Yeah. We're going to be looking at some of the techniques, methodology, strategy that can make it work. We're going to be exploring key financial ratios like DSCR, you have heard about it, LLCR, to understand repayment structure and building flexible financial model. And this session will be filled with a lot of actionable insight, for developers, lenders, finance professionals alike. By the way, in the comment section, if you haven't started yet, please let us know who you are, where you're joining from. If you have any question, that's fine. Because I'd like you as well to make sure that you have questions ready, because we're going to have an area where you can actually ask those questions, and that'd be good. And I'm very fortunate to have exceptional lineup of speakers. But usually what we do, we like to start by having a quick poll survey, because it helps us to understand, where we are here. So what do people think about the topics, where and what is what is their opinion? And after that, it helps us to properly tailor now the conversation that we're going to have today, especially for our speakers, so that they can hopefully respond to your questions. So what I'm going to do, I'm just going to share the poll now. And please do me a favor. I like to have as many people as possible to complete it, because, like I say, we like when things are interactive, when people are contributing. And I could see there's already a good number of people, 39 of us, and I'm sure it's just going to keep on adding. So the first question is asking you, so what is your primary objective for attending this webinar? I'm sure you've seen the topic, you've seen the speakers, but why are you attending? So do you want to learn about debt sizing, better understand the financial ratios, explore repayment structure, gain insight? So you tell me. So that's what the first question is all about. The second question I'm asking you, so how familiar are you with project finance and also debt structuring? Very familiar? Somehow familiar? Limited knowledge? Not familiar at all? I mean, there's no wrong and right answer here. I mean, I just want to know, so in the audience, so where people are sitting, so that I'm sure I'm going to ask to all the speakers to make sure that they pay attention to that, and also when they respond to that. And this last question is, which aspect of project finance do you find most challenging? Yeah. Is it understanding debt capacity or sizing? Is it navigating repayment structure? Is it applying financial ratios? So what is that? So you make your choice. So I like to have a lot more participation than what I have right now. I have 15 people that responded already. Thank you very much. I appreciate that. I'm gonna leave it running for another minute, and after that, I'll stop it. I'll show the result that we're getting, so that we get an idea. And after that, we can move to the next part. Is it okay? So I'm just gonna give you a chance to then do that. So while you're doing that, I'm just gonna obviously make sure that I will unmute my colleagues here who will be speaking, because I will need them to introduce themselves in a minute. Yeah. So please, guys, keep an eye. 24 people, yeah, contributing already. That's fine. That's great. So, and after that, I will display the result that we're getting. And after that, we can carry on. Yeah. And by the way, thank you for joining as usual. So very, very grateful to have you. So let me now go and display the results. I'm gonna stop the poll now. So I'm just share the results so that we could see. So hopefully all of you can see the results. So what we see here, 64% want to learn about debt sizing methodology. I think you're in the right place. I guess that's why you are into this webinar. So and what we have, 14% explore, 40% gain more insight. How familiar we are? Oh, it's actually quite split in here, right? So it's actually almost similar for the first three. So I mean, about half of third of people will say they're very familiar. Another third say that they have limited knowledge. So a quarter say they're somehow familiar, and 4% not familiar at all. So not a problem at all. That's great. And when it comes to which aspect project finance people find most challenging, you have almost half of it saying that understanding debt capacity and sizing. Again, you are at the right place. Yeah, that's why we're having this conversation. So repayment structure, that's about a third of the people, 29%, roughly speaking. And then we could see. So I'm hoping that all the speakers, my colleague speaker here, you could really see what we get in here. So, and it gives you some idea of what you would need to cover. So no pressure for you, but there is a good job that you need to be doing here. And without further ado, so I say that I'm very privileged to have speakers that will be obviously intervening into this webinar. So I'm just going to ask them to introduce themselves one by one. So Kame, I can start with you because I have you in the picture, and then after Kame, I'll go for Chris, and then Gabriel. Oh yeah, Kame, hopefully you can hear me.
Thank you, Tony, and thank you everyone else for joining us today. My name is Kami. I'm an analyst with Numeris, handling financial modeling and valuation.
Excellent. That's great. Short and sweet. That's what we like. So can we get Gabriel? Or yeah, Gabriel, is Gabriel connected? I think Gabriel's connected. I believe. Let me just ask you to unmute. Gabriel, you should be able to speak now. Gabriel.
Thank you, Tony, and thank you everyone for joining. Gabriel Nyashani is my name. I work as an assistant manager with financial modeling at Numeris. Thank you.
Terrific, terrific. So, Chris, yeah, if I can have you to also have a quick introduction of yourself, please.
Thanks, Tony. Good day, everyone. My name is Chris Buerta. I'm a co-founder and operations director at Merchant Energy. We are a renewable energy project developer and IPP based in Cape Town, South Africa.
Okay, excellent, excellent. Thank you very much, Chris. I appreciate that. So last but not the least, can I have Rutendo if she's unmuted? If not, I'll do so in a minute. Yeah, she's unmuted. Yeah, Rutendo.
Great, thank you, Tony, and hello, everyone. My name is Rutendo. I am a director in the valuation space in Numeris.
Excellent, Rutendo. That's fine. In fact, I will stay with you. As you see, we really have heavy weight of the industry here. So you guys are very lucky, because to have session like that, normally, I'm sure you know you would have to pay for that. Yeah. So feel free to give me part of it. I wouldn't say no to that. So Rutendo, I think we're just gonna move very quickly because as I said, the program is very heavy tonight, not tonight, today. And if you can do a very brief introduction of Numeris as a company, so that would be great. I believe you have a short presentation, right? Otherwise, you can also do that verbally. It's up to you. So I'll leave it up to you. So are you sharing your screen, or what would you do?
Great, thank you, Tony. We do have a presentation, and my colleague Gabriel will just present a couple of slides for me to talk to.
Okay, so Gabriel, feel free to share your screen, and it should be working. If not, you let me know. Excellent. So let's go on big slide mode. Excellent. Yeah, you're on, Rutendo.
Awesome. Thank you very much, Tony, and a very good morning, good evening, good afternoon to all our audience joining us from various locations across the globe, and welcome to this webinar on mastering debt sizing presented to you by Numerous. Numerous specializes in providing financial modeling and valuation services for projects and transactions that deliver impactful changes in Africa, which are also aligned with the United Nations Sustainable Development Goals. We are passionate about Africa and contributing towards making a lasting impact across the continent and the globe. We provide services across various industries, looking at the flow of capital to critical sectors in order to provide and prepare Africa for growth within the short term, the medium term, and the long term, of which clean energy is a big focus for us. We also play in the infrastructure, agriculture, education, and healthcare space, aiming to make an impact through our service provision. So our services can be split into two areas, being the provision of valuation services and financial services. Under the valuation services, this includes the performance of business valuations, IP valuations, fairness opinions, and valuation reviews, while our financial modeling services include model builds, model reviews, and training. We have a strong team with many years of experience in the transactions space across sectors and geographies globally. Our leadership team is made up of Ruben in Mauritius, who focuses on financial modeling and valuations, Nathan in India, who specializes in valuations, and myself, Rutendo. I am based in South Africa, and I focus on valuations. The leadership team is supported by our assistant manager, Gabriel, who is based in Cape Town, and two analysts, being Edna and Kame, who are both in Kenya. Together, we form the core team that provides financial services and valuation services across the globe. Some of the key projects that we've worked on to date include the provision of infrastructure modeling, where we've performed services for wind and solar farms across Mauritius and South Africa, university housing projects in Nigeria, as well as a waste recycling plant in Mauritius. Our valuation credentials also include valuations for fundraising purposes, M&A valuations, and purchase price allocations. I now hand you over to my colleague, Gabriel and Kame, who will be taking us through the webinar on mastering debt sizing. We are also privileged to have Chris Boita, an industry expert, who will share some insights and industry best practices throughout this webinar. Thank you for joining us, Chris. And over to you, Gabriel and Kame.
Excellent. So Gabriel, please.
All right, thank you, Rutendo. Once again, everyone, thank you for joining us today for this webinar. We are excited to explore this critical topic on debt sizing for project finance. Here's just a brief overview of today's agenda, understanding of project finance. Then we'll go into the key debt sizing inputs and the debt sizing methodologies. We'll then look at the coverage ratios and the debt repayment profiles. And finally, we'll bring all this to a close with a case study that Gabriel will take us through, where he'll demonstrate how debt sizing methodologies and coverage ratios are applied. So we'll also have the time for the Q&A at the end. So please feel free to drop your questions in the comment section. Of course, privileged to have Chris, who will be with us through the first hour. We'll engage him at various points during the presentation to build more on the discussion. Thank you, Chris, once again. So let's get started. So we'll start just with basic definition. What is project finance? So project finance is a specialized financing method in which the project itself is treated as a separate entity from the parent company. It is therefore suited for large, capital-intensive, and long-term projects like infrastructure, energy, or industrial developments that require substantial upfront capital investment. So how is this done? It involves structuring funding around the specific cash flows and assets of the project, and the lending decision is normally determined by the project's potential success. The special purpose vehicle or the special purpose entity is the primary mechanism used to separate the project from the parent entity. This allows the company to take on bigger projects without negatively impacting the parent company balance sheets. So there are certain key concepts in project finance that differentiate it from corporate finance. We'll not go into the details of all this, but here we've mentioned non-recourse, risk sharing, off-balance sheet treatment, and specialized contractual tools, among others. But of more relevance to our topic today is the risk sharing element. This concept of project finance fits into our discussion as we evaluate the mechanisms of risk allocation. For instance, various debt covenants, such as the coverage ratios, the debt service reserve accounts, requirements are intended to ensure effective risk allocation and management. So just to further conceptualize what project finance is, we'll also look at other drivers of our project, other discussions around project finance. We look at the 3 stages in project finance. Infrastructure projects typically progress through 3 key stages. We have the pre-bid stage involving feasibility assessment and tender preparations, among others. The post-bid stage focusing on capital raising and contract negotiations. This would typically take 6 months to over a year or more than that. And the post-financial close when operations begin and the debt repayment starts. So I'll stop here just to give Gabriel to take us through this in more detail in relation to financial debt modeling. Gabriel, are you there?
Yes, I've unmuted him. I think it should be
Okay.
Gabriel.
Thank you, Kame, for that introduction to the 3 stages in project finance transactions. So basically, as Kame has alluded to, there are 3 stages that project finance deals, like your wind farms, infrastructure, or any other energy project. They go through the 3 stages, which is the pre-bid, the post-bid, and the post-financial close. So it is very, very important for a financial model to behave differently depending on which stage of the project life cycle it is at. So we have very important inputs here, like your internal rate of return, the tariff, the debt service coverage ratios, and the gearing. During the pre-bid stage, you can see that the internal rate of return is not yet determined. The tariff becomes an output because it's not yet known. The coverage ratios is an input, while the gearing ratio becomes an output because it's not yet known how much will your project cost. Then we go now to the post-bid. Now it is maybe during the construction phase where we are saying now it's pre-financial close. The things change a little bit. The IRR becomes the output. At this stage, you find that the price is fixed. The debt service coverage ratios remains input. Then we go to the financial, the operations. I can call it the operation stage or the post-financial close. At this particular stage, the IRR it becomes an output. The tariff or the price is now fixed. Then you have your debt service coverage ratios. They becomes an output, and gearing by this time they are fixed. Okay. So now we need Kame to take us through the debt sizing methodologies, where she will talk into the nitty-gritties of debt sizing.
Okay, thank you, Gabriel. So there are certain key concepts we need to be familiar with at this point. First, what exactly is debt sizing? So debt sizing is about finding just the right amount of debt that a project can take on to remain financially viable. So the debt capacity or the debt size is determined by the project cash flows and risk profile in project finance. In evaluating the debt capacity or how much they're able to lend, lenders usually look at the cash flows available for debt service after deducting key operational expenses from the project revenues. So this is what is simply known as the cash flows available for debt service, or in short, CFADs. And it is an important variable when determining the optimal debt size. So besides the cash flows, lenders will also look at various financial matrices, such as the maximum gearing levels, the DSCR, to determine ideal debt size. So, for example, lenders will usually specify a certain level of debt service coverage that has to be maintained throughout the project or the loan tenure. So just a bit of background to this again. When determining this optimal debt size, there are various inputs that play into this. For example, we talk about maximum gearing. So gearing basically is the degree to which the project is funded by debt. So maximum gearing represents the highest allowable debts, and this is normally limited by various constraints and is defined in the financing term sheet. In debt sizing, this parameter is crucial for ensuring that the project does not become over-leveraged, which could strain cash flows and increase default risk. The next one is the debt tenor. This basically refers to the length of time until a debt obligation matures or is fully repaid. This is determined by various factors. The project itself, of course, no lender can give a debt tenor that extends beyond the life of the project, or even exactly matching the life of the project. So we'll revisit this in more details and look at the loan life and the project life coverage ratios as well. The loan interest rate, this an obvious factor. It's determined by various factors such as the market rates, the loan duration, and other project and counterparty risks related. So the other key input, the target DSCR. When you talk of the DSCR, we talk of the debt service coverage. This measures the project's ability to meet the debt obligation by comparing the cash flows available for debt service to the corresponding debt service obligation in the same period. So lenders typically set the DSCR above 1. It's always above 1 to ensure the project generates sufficient surplus cash flow to cover its debt repayments, also while providing a margin of safety. So basically, for riskier assets, they'll require higher DSCR, and then for less risky assets, the DSCR should be lower. We also have the target LLCR. LLCR basically measures the project's ability to service its debt by comparing the PV of the project future cash flows. And when I talk of cash flows, we're talking of the CFADs, not all the cash flows, but the cash flows available for debt service. So by comparing the outstanding debt at any particular time, they're able to evaluate the project's ability to cover its obligations. So the target LLCR helps set a baseline for acceptable debt service coverage, ensuring the project has enough cash flow to meet its obligations. Set aside to provide financial safety net for lenders. The reserve account is normally funded in full upon completion of construction, or it's typically sometimes built up over time from the project's cash flows. So this reserve fund is set aside to protect lenders in case of cash flow shortfalls or their operational interruptions. So these are just a few of considerations we look at when debt sizing. And at this point, I'll request our guest speaker, Chris, if you could come in here and maybe lending decisions. Over to you, Chris.
There we go. Thanks, Kame. Yeah, so those are some of the obviously key parameters that you've set out. I think just from our experience, things like maximum gearing levels and DSCR levels are normally driven by bank mandates. So for example, even in some of the renewable energy projects that we see in South Africa that have substantial cash flows, you're not going to get a bank that's going to offer you 100% gearing on that project, even though the cash flows might be able to sustain that because they have mandate limits within the bank themselves. So typically for renewables, we see baseline gearing of about 70% or so. However, lately banks have been fairly aggressive, and it's not uncommon to see senior debt levels of 85% for renewable projects. Just another comment on the debt service reserve account. Also, the purpose of that, as you rightly pointed out, is to cover any senior debt service. But interestingly, a lot of the any senior debt service shortfall that might arise for whatever reason. Interestingly, we're also seeing that banks are more and more willing to use something called a debt service reserve facility. So in other words, instead of setting cash or equity aside to cover any kind of short-term shortfall in your debt serviceability, the bank actually gives you another facility that you can draw on. So in essence, it's additional debt that you can draw on, a different facility that you draw on to cover any shortfall in your senior debt service. And that's simply to cover, some irregular kinds of shortfalls that might occur. For example, most projects are insured. So if there's an interruption in your revenue stream, that typically is insured, but you may have to wait a few months for you to receive that money back from the insurer, in which case it wouldn't be the most efficient approach to utilize equity to plug that gap. And that's where something like a debt service reserve facility is very useful, where you use that second facility to cover your debt service. And then once the insurance money comes back in, you top up that debt service reserve facility again.
Okay. Thank you, Chris, for that input, and it's really true. Now we are moving to the approaches to debt sizing. So as indicated earlier on, we size our debt based on fixed leverage approach and the debt service coverage ratio approach. So when we are talking about fixed leverage approach, it uses the maximum gearing ratio, e.g. 70%, to calculate the total amount of debt, in which case the debt service coverage ratio becomes an output. Then when we are using the target debt service coverage ratio approach, here what we are doing there, we are back solving the maximum debt supported by the target DSCR. In this particular case, you find that your leverage becomes an output. So when we are using these two approaches, we need to take the minimum of the two. So you shall see in Excel that we use the min function of Excel to say, okay, based on fixed leverage and target debt service coverage ratio, you'll be having two debt sizes. So which one do you go with? So you go with the minimum of the two. Then at this particular stage, we will invite also Kami to talk about the coverage ratios that we normally see in debt sizing.
Thank you, Gabriel. So before we go into the coverage,
Gabriel, can you hear me? Yeah.
A few of the building blocks in computing coverage ratios. First, there's the cash flow. These CFAs basically reflect the actual. So it's a hello. Sorry.
Yes, Kami, you're breaking up a little
bit. Am I audible?
But carry on for now. So hopefully it can stabilize.
Okay, let me know just in case I can't start over. So, okay, they're requesting for a start over. Is it okay now?
Yeah.
So, before we look at the coverage ratios, we need to look at some of the building blocks of coverage ratios. The first one is the CFADs, or the cash flow available for debt service. This is basically the cash that the project generates and is used to meet the debt obligations. We calculate this by taking the project revenues, subtracting any operating expenses, adjusting for any working capital adjustments, then less taxes and any maintenance capex. That's how we arrive at the cash flows available for debt service. Okay. So the next parameter we have looking at is the debt service. We've been referencing this. This is simply the sum of the principal and interest repayment during a period. The debt service is usually also includes other associated fees such as arrangement and administrative fees related to the debt raise. So the debt service amounts vary depending on the debt repayment profile, whether this is structured as an annuity, a bullet, or as captive repayment. So we'll have a demonstration of this in the case study. So to the coverage ratios, to define DSCR or debt service coverage ratio, it measures the ability of the project to meet its obligations. So it's calculated as the CFADs of the cash flows available for debt service divided by the debt service, basically the principal and interest in each particular period. So as you can tell from the formula, when CFADs are higher than debt service amount, we shall have a DSCR higher than 1. This implies that the debt obligations for the period is adequately covered. So DSCR below 1 would therefore be indicative of insufficient project cash flows. And the risk of default increases for projects with DSCR less than 1, especially when we do not have a reserve or a reserve facility in place. So from a banking perspective, a higher DSCR implies that the project is as perceived as more risky, and the vice versa is also true. So banks tend to put the high base the target DSCR on the riskiness of the project as well. So, okay, so DSCR, we've looked at it in how it's applied to evaluate the riskiness of the project, but it can also be used to size the debt. So one way to size the debt is by using the target DSCR. So looking at the first formula there, here we first determine the debt service amount for a project based on the qualifying CFADs and the target debt service ratio. So by dividing the qualifying CFADs by the target DSCR, we are able to calculate the maximum amount of debt service that the project can support in each period while maintaining the target DSCR. So two conditions have been met here. By using the CFADs or the cash flows available for debt service, the project capacity has been accounted for. And then by using the target DSCR, a covenant condition has been met. So once the debt service amounts are determined for each period, we calculate their present value using the cost of debt as the discount factor. So this present value of debt service amounts represents the total debt that the project can sustain. So we have now sized the debt using the CFADs, the cash flows available for debt service, and the target DSCR. So remember, the debt amount relative to the project capital would represent the gearing. So by working backwards using the qualifying CFADs and the target DSCR, we are able to come up with an optimal debt size, and we are in turn able to maximize the project leverage. So the last formula there, that's just to show how beneficial this is, meaning higher equity IRR. One way of looking at this is, if the project is financed with more debt than equity, it means there's lower equity investment. So for the same level of project cash flows and profits, the return on equity is normally higher for high gearing or a highly geared project. So Gabriel will also demonstrate this for us in the case study. So we have now looked at how target DSCR can be used for debt sizing. It is an important metric. So what happens when the project is unable to meet this target? So as we mentioned, loan agreements specify certain financial covenants, such as the minimum required DSCR that the project should maintain. So after a financial close, so during operations, lenders will typically use these ratios to monitor and control the project functions. So where ratios do not meet the minimum required DSCR, lenders will have a series of interventions that they resort to avoid, to mitigate their risks. So one of the interventions is the lockup ratio. The lockup ratio basically is the DSCR level at which the lender will enforce certain measures to mitigate its risks. They can impose a distribution block, basically to stop any dividend payments, or they'll require cash sweeps where any cash flows and reserves are applied towards debt repayment. And then if the DSCR falls below a certain critical level, maybe below 1, it could trigger a default event. which is never good. So, but of course, declaring a default is never in the best interest of the lenders or the borrowers. So I'll pose this question to Chris at this point. How is this typically managed?
Thanks, Kami. Yeah, that's a very good question. Obviously, for project owners and project sponsors, this is typically something that can be quite scary as a concept, and it's something that one typically wants to avoid at all costs. But it is true that the bank wants to actually avoid this at all costs as well. And you'll find that in the project finance contractual framework, so the security package that the bank would require for project finance deals, if we use renewables as an example, you would have all these financial covenants, DSCRs, LLCRs, things that you've mentioned. Then they would have the debt service reserve account or facility to help cover debt service. But then they would also have step-in rights into all of the underlying contracts. So, for example, the EPC, the construction contract, the O&M contract, the operations and maintenance contract for whoever is running the plant. Even the land lease, most of the time, the bank would have step-in rights. So if there's an underperformance of the plant for some reason, then the bank would step into the shoes of the owner to try and rectify that issue in order to get the cash flows back up to where it needs to be in order for the project to be able to continue to service the debt. So there are actually many levers that the bank can pull to try and avoid a default scenario, and they would certainly try and do so as much as they can. That's not to say that projects don't default. Of course, projects default, but with the right security package and the right contractual framework, most of the time there are interventions that can help avoid a default situation.
Thank you, Chris. So before we move on to the next section, just a brief on the loan life and the project life coverage ratios. So I previously mentioned that no lender, of course, Chris also reiterated that no lender will give you a loan period extending beyond they'll never give you a loan matching the project life or extending beyond that. So one drawback of the debt service is that it does not consider the time value of money. Excuse me. So the loan life coverage ratio looks at the ability. A minute, please. So it looks at the it looks at the ability of the project cash flows to service the debt over the entire life of the loan. Gabriel, if you could just take over.
Thank you, Kami. Okay, so basically, when we're talking about the loan life coverage ratios, we have seen that the debt service coverage ratio, one of its shortfall is that it does not take into account the time value of money. So the loan life coverage ratio is now able to resolve this issue. What it does, we have seen that to calculate the DSCR, you just take the periodic cash flows, then you divide by the debt service. But now, when you're looking at the loan life coverage ratios, you are talking about the entire cash flows available during the loan tenor. Then you divide that by the outstanding debt. So here, what we are saying there, you are seeing that the lenders, they size based on the NPV of future CFEDs using the target LLCR to provide some margin of safety. So usually, if you do your computation and find that the LLCR is less than 1, it signifies that the cash flows, they are insufficient to service the debt. Then when your LLCR is above 1, it simply shows that you have sufficient project cash flows. Then lenders, they usually put stipulations to say, no, for us to be on the safe side, your loan life coverage ratio should be 1.25. So here I'm specifically talking to what is normally referred to as the rolling LLCR. You shall see in my model how I calculated the rolling LLCR. So, but if a debt has been sculpted well, you will see that the loan life coverage ratio would remain above 1 or above the target LLCR for the entire debt tenor.
Thank you. Thank you, Gabriel, for this.
Okay.
So basically, to compute the LLCR, it should be the NPV of the CFADs or the cash flows available for debt service divided by the outstanding debt. So as earlier mentioned, of course, the initial assessment for a project's ability to service debt also includes this LLCR factor. And lenders often require a minimum LLCR as part of their loan covenants. So on to the PLCR finally. So this is also critical in evaluating the project's ability to service its debt. So the PLCR measures how well the cash flows generated over the entire project life, even beyond the loan, can cover the project's obligation. This approach recognizes that cash flows beyond the loan's life are just as important as those within that. So why? Because these post-loan cash flows act as a buffer. In the event of revenue disruptions, whether they're operational hiccups or unforeseen market conditions, this buffer, commonly known as the debt tail, ensures that an additional cushion exists to meet their debt obligations. Now, onto something more important here is lenders never structure loans to match the full project life that we've mentioned. So instead, loan tenors are deliberately shorter, ensuring that the project has critical cash flows beyond the debt's maturity that can be used in case of any such eventuality. So when you're computing the PLCR, note that the discount rate for the last debt service period, basically the last debt service when we are repaying, that discount rate is what will be applied to the cash flows beyond the loan life, which is the debt tail. So that's one thing we need to really look at or consider. So before I hand over to Gabriel, maybe to take us through the debt repayment profiles and the case study, I would like to invite Chris here to wrap this section up for us. I know you'll be leaving us at the top of the hour, so maybe if you give us some feedback on this before now Gabriel goes into the debt repayment profiles.
Sure. Yeah, just a couple of additional thoughts from my side. On the loan life coverage ratio and project life coverage ratio, for most projects, one would expect these ratios to increase over time, and that's mostly because project revenues tend to increase over time. For example, in energy projects, the tariff has an escalation factor every year, meaning your revenue increases every year. Mining projects, for example, would expect commodity price increases hopefully over time, but irrespective of whether your revenue increases, you'll have the debt level decreasing over that period in any case, which means that these LLCR and PLCR ratios should hopefully increase. So it's really mostly a test that you do at the beginning when the debt is sized to make sure that there's sufficient coverage, as you point out, for the loan to be repaid. I think one other point to note is that we've spoken about sizing the debt using the DSCR or using maximum gearing. But then a very common practice is also to then calculate how one actually repays that debt. So, for example, you'll have an amortizing loan schedule, which everyone on the call should be fairly familiar with. It's normally how your house repayments or your car repayments are calculated, where you have a fixed installment over each period. But for project finance, the most common approach that we're seeing in South Africa is effectively a sculpted profile, where you actually repay very little capital in the early years. You actually mostly repay interest, and then the capital portion increases quite dramatically as you go on. And that's because of the point I mentioned before around the fact that your coverage ratios tend to expand as your project progresses, meaning the coverage ratios are under the most pressure in the early years. So in order to optimize returns and to optimize equity cash flows, you would certainly look to a bank to assist you with a sculpted profile, so as to push some of those debt service payments back a little bit so that you're not under that much pressure in the early years. That's definitely one of the more common ones we've seen. And then final comment on the DSCRs, a lot of the work around DSCRs get done upfront when you're engaging with the bank to obviously to negotiate the terms and negotiate the gearing, etc., and calculate what your equity IRR and perhaps your tariff would be for a renewable project. And in that case, you do a periodic DSCR test. So, for example, it's mostly backward looking over a 6-month period. Does the model say you'll have sufficient cash to cover your debt service and therefore make an equity distribution? But then, interestingly, once you go into operations, you need to report back to the bank on a periodic basis, say semi-annual basis, and they ask you to do the covenant testing. And in many cases, they ask you to do 2 DSCR tests: the backward-looking test to confirm that your cash flows are sufficient and you meet your covenants. But then also, in order for you to pay a dividend, you need to do a forward-looking DSCR test to show to the bank that you expect to have sufficient cash over the next 6 months to be able to cover the next debt service. And therefore, you would request a certain amount to be paid out as dividends to shareholders. So again, Gabriel touched on it at the beginning of the presentation. There's always like a pre-financial model, and then there's an operational financial model, which might look slightly different and have a couple of other functions in there that you wouldn't have before you kick off the process.
Okay.
Sorry, Kami, one last point before I let you go. We didn't really touch on it now, but another common mechanism that's used in South Africa is the concept of mezzanine debt. So we've spoken about senior debt throughout this whole presentation, which is really the main contributor of capital to a project. But then in order to further enhance equity returns, what sponsors often do is introduce senior mezzanine debt, which might be at the project company level, but it might also be at a shareholder level. And it's effectively just more expensive debt. So if you have let's say a 30% equity requirement in a project, you might go and borrow equity financing at a higher rate than what your senior debt in the project would be to further reduce your ultimate equity check that's required in the project and ultimately enhance your equity returns slightly as well. So in South Africa, you'll find it's not uncommon to find projects with 80% senior debt, a further 10% mezz debt, and then ultimately only 10% of real equity in the project. So they are highly geared. And as you can imagine, those calculations and those sensitivities on coverage ratios become quite an interesting exercise in such a case.
Thank you, Chris. That was really comprehensive. Thank you for that. So in this particular section, we were going to talk about the repayment profiles, and Chris has already touched on them to say we have the principal repayment or the fixed, then we have the annuity or the amortization, then we have the sculpting there. So he has already touched about this, so I'm not gonna repeat what he has indicated. It's just the continuation of this debt repayment profile, because after you have sized the debt, you're now saying, how am I going to repay it? So definitely that's what this slide is saying. So this is the sculpting that he has mentioned. So to determine the sculpting, you're just saying your principal is equal to your cash flow available for debt service. You divide it by the debt service coverage ratio, then you subtract your interest. Then if you sum up the principal repayments, then it becomes your total debt. But it will be incomplete for us to talk about debt sizing and neglect circular reference. So in project finance, there's what we call the construction financing or the construction cost. So when you are determining the construction costs, you'll see that there will be interest that you're supposed to pay during the construction. So those interests, they need to be determined by the debt size. But to determine the debt size, you need to determine the interest that is also feeding into the construction cost. So there is circular logic there. But in our financial model that we are demonstrating today, we are not showing this part of a circular reference. We just trying to show the simplicity of our model. But we are showing the next sign of circular reference to say, where is it emanating from? It is emanating from using CFEDs to to derive debt sizing, which also feeds into debt interest, but debt interest, it feeds into tax. You need tax to determine the CFEDs. So there's also that circular loop there. So we're in our model, this is what we have demonstrated, and the most industry practice way of resolving circular reference, which is the copy and paste. So we have just developed that one. You shall see in when I'm presenting the case study. Right. I think now you have been waiting for too long, and let's jump into Excel. Okay.
Excellent.
Yeah.
I think you guys have content there for at least maybe another 4 webinars.
Yeah. Let me share my.
Yes.
I don't know if my screen is visible now.
Yes, I think it's very visible. Yes, that's fine. You can go ahead.
Thank you for that, Tony. So basically, the model that I'm presenting here is just for illustrative purposes. It's just for illustrative purposes. So in real practice, a financial model, especially for project finance, for infrastructure projects, it can be quite complex, but in this particular case, we've just make it for presentation purposes. So you shall see that we have the dashboard that we are seeing there. Then we have another sheet that is our inputs. Then we have this input is input C, where we put our constants. Then we have the engine, which is where I did all the calculations. Then when I'm building financial models, we normally need to put the checks. So you see that this is for the check, this sheet. Then we have the one for technical. This is just for doing the name ranges. Then we have our timeline. So to start with, this is just a simple model. We've just taken it's a wind farm of 20 megawatts. So we are just saying it has got 2 phases. You see that it has got the construction phase and the operations. So we have just put it very simple to say let it be 2 years and construction and operation for 12 years, just for simplicity. And you shall see that the model is having 5 cases. So we have the basic case, then we have the case 2, which is the higher debt service coverage ratio, then the lower case, then the short life. Short life here, I'm not talking about the project life, I'm talking about the loan tenor. Then we have a case of high leverage, right? As you all know, that project finance is highly geared. So in this particular column here, it is the column that is driving the model. You will see that there are some inputs that are painted in that has got this sky blue background. It means that these are our inputs and these ones are our calculations, right? So we have made it very flexible. You can be able to change any currency that you want there. Then our capex is made up of these 3 costs: your base cost, the development costs, and the grid connection fees. We have made it very simplified. Then we also put in some depreciation there. We are using the simple one as the straight line depreciation. Then we come to the funding stage, where we say we are funding using debt and equity. And the infrastructure for debt, we know that there is the tenor, there is the grace period, and we have our minimum DSCR. Then the methods of repayment, we have chosen the 3 methods there. Yeah, then we have our target equity, IRR, then the tax inputs, right? Then when I come to input S, this is just the inputs that are dependent on time. So here I've only put some best cost allocation and the interest rate, and you shall see, as you can see, the interest rate it's changing each and every year. Then we come now to the engine. As we see on top of there is a timeline. Then in that timeline, under the timeline, we have the uses of funds. I've calculated a bit of some cash flows and depreciation, tax, and senior debt. And you can see the timeline is built in a very flexible way. And there are also flags there that are computed. Okay, it's coming from the timeline sheet. Yeah, without any further delay, let's us get into the nitty-gritties of debt sizing. As we have indicated before, we size debt using the two approaches: the maximum leverage or gearing. You hear me saying leverage or gearing. I'll be using these names interchangeably. So we have the senior debt. This number is coming from the input. So if I can just press F2, it takes me to the what is coming from the input. Then the project cost, it has been determined in our uses in our uses of funds there. If I can just show you the use of funds there, these are the use of funds. So the total project cost is around 335, and to fund this particular project, we are using the equity first method, where we say you need to put in your equity. Then after putting in your equity, then we put in the debt. So you can see how I am putting in the equity there. After the equity, now we come to debt. Let me close this one. I won't be using it that much. Right, now I come to debt sizing. Now that I know the project costs, I now need to determine the debt size based on leverage. So if I can just say 65% of the total project cost, I get my my debt size. That is using leverage. Now, remember I said we have two approaches. Another one is to use the target DSCR. So the target DSCR, we need to say, okay, what are the CFEDs, right? The CFEDs are coming from this calculation there that I named the free cash flow. I just started at EBITDA, then I subtracted the, if I can come to where I determined my CFEDs. They are determined here, where we are just saying after we take our EBITDA, then we subtract the corporate tax, then we arrive at CFEDs, right? So that's where our CFEDs is coming from. But remember what we mentioned to say there are circular references that okay, when we try to size debt from CFEDs. So this, you can see this this column here that is painted, that has got a different color. These are the pasted values of the live CFEDs. Now, when I'm coming now to senior debt service at coverage ratio, I'm just taking the CFEDs that are pasted, then I divide them by the target DSCR. So you can see the formulas are very consistent right through. So that's what is happening there to determine the debt service at coverage ratios, right? Then when we are done, we had Kame talking about the present values after we have determined the debt service, we need now to take the present values using the cost of debt as a discounting factor. So now we are discounting these cash flows. We are discounting these cash flows to arrive at debt size. So if I can come to this particular column here, you can see that I'm taking the sum product of the senior debt service and the discounting factor. And this discounting factor, where are they coming from? They are coming from downstairs here, because my interest rates are changing over time. So I could not use the normal NPV in Excel, but we use the sum product. So the sum product, we are just saying what it does. It just takes the individual debt service multiplied by the corresponding discount factor. Then when we look at this debt size against the debt size by leverage, you can see that the debt size by target DSCR is lower than the debt size by leverage. Then we take the minimum of the two. If you remember very well, I've mentioned that if we have sized the debt using these two approaches, now we need to go with the minimum. So I just computed the debt to capital ratio then to arrive at this particular ratio. So now I'm comparing this ratio versus this. But another way of doing it, we could have just taken the minimum of these two numbers, and that minimum is 208. Now that we have determined the debt size, right? Now that we have determined the debt size of this project funding, we are now saying, how do we go about paying this particular debt, right? So we have touched on three approaches, where we have said we have the principal repayment approach, we have the annuity approach, and we have the sculpted principal repayment. When we are using the principal repayment approach, what we normally do there, we take the principal, that one, then you divide it by the sum of the repayment flags, right? Or in simple terms, we could have just divided by 8. So you can see that it's constant. It's constant right through. So if I can just try to graph that a little bit, you can see that it's constant right through. That's why it is called the level principal repayment. So I can quickly delete that. I can delete that one. Then I come to the annuity. Annuity repayment, what I'm doing there, I'm just saying, okay, what is the sum of my discount factor? Then I take my loan, then I divide it by the discount factor. So you can see that it is constant right through. This 37,628. If I can add, because that one becomes our debt service. Remember, debt service is principal plus interest. So if you can check the sum of this, it's 37 there, 628. You go to the next period, is the same. The summation of this is the same. The summation of this. So it becomes what we call an annuity or a level debt service repayment structure. Now we come to the sculpted principal repayment. What we are saying on this particular stage, we are saying, okay, what are the CFEDs, right? I take my CFEDs upstairs there. Then I say, okay, what is the target debt service coverage ratio? I take my debt coverage ratio from the input sheet. Then I divide to get my principal, to get my debt service. Now that I have my debt service, to get the principal repayment, I just need to subtract the interest from the total debt service. Where is this interest coming from? It's coming upstairs. It's coming from upstairs there, right? I'm coming back to it shortly. That interest there, say, okay, it is being calculated based on the opening balance. Why am I doing that? We are just trying to avoid unnecessary circular logic. It is common in project finance that the interest is calculated based on the opening balance. Now we come to say, okay, in our model, how are we going to structure it in such a way that the user may want to use either sculpted, either annuity or level principal repayment. So what I did here is just a simple index. I'm just indexing the payment method that is running into our model. So this payment here is the one that comes into this section here of this particular model. So this is the senior debt balance. It is tracing the amount of debt that is remaining at each particular period. So you will see that when we reach the end of our repayment, we shall have paid the entire amount of loan. That's why you are seeing here there's zero here. So this one, it is working like we normally call it it's a corkscrew. You can see that the opening balance of this particular period is the closing balance of the previous period, right? Then the drawdowns, the drawdowns that are coming from the uses of funds upstairs, right? It's coming upstairs there. These drawdowns, these are the amount of debt that we have drawn for this particular project. Now we come to the principal repayment. How are we determining the principal repayment? We're just taking the minimum of the two. Why am I taking the minimum of this particular figure and what is downstairs here? Why am I doing that? So that I do not over repay my debt, or so that I do not over repay my debt. You can see I've taken out this amount of debt and I've repaid this amount of debt. So that's a corkscrew. So if I can just show you where is this one coming from, you can see that it's coming from it's feeding here. Let me just say it's coming. Yes, it's feeding there. Let me say this one. Where is it going? It's going there. When it comes from there, it now comes down there. So it's a corkscrew. Let me just delete those arrows there. So now that's how we structure our debt repayment. Now let me quickly go to the calculation of the LLCR. The LLCR, you have seen that when we are doing this calculation, we normally start from the end. It's like we are using Excel in reverse order, right? We are bridging the rules here, right? We are breaking the rules. So here we are taking the CFED during the term of the loan or the life of the loan. Then we say, okay, what is the present value of this particular figure? So if I do like this, you can see that this particular figure is the present value of what is in the future. If I come again here, it is the present value of this particular figure, and the sum of what we have discounted already. So in other words, you are now discounting the 64303. You are discounting it twice now. As you move backwards, this is what we call, it's a rolling LLCR. That's how the calculation is what is happening there. It's going backward. But when you check your the coverage ratio, it remains constant, right? Same applies. It's the same calculation with the LLCR. It's not with the PLCR. The PLCR, it's we are now just taking the cash flow over the entire project life. Now let me come to the dashboard to see how these are tied together. Right?
Gabriel,
when we are
sorry to
yes.
I just jump in very quickly. Because I think I just want to be a little bit conscious of time. Obviously, what you're showing there, it's very, very interesting, and I didn't want to sort of cut you just short. What I could suggest is, if we can find a way to maybe wrap it up in a couple of minutes, and we can just invite questions from people. And what I was gonna say, which was part of what we're gonna say today, is the great thing with this webinar. We understand that could be very technical, and some people find it very interesting, because I'm seeing the comments as well. I've also already received some couple of emails. So what we've done is actually we've planned some one-on-one that people can have with the team, of the Numeris team. And I'm going to invite my colleague Brian just to drop the link in the comment box there. So I mean, if you have a project or you want to go a little bit more deeper into this, have a bit more information, because I'm sure you could see we can't cover everything else. So you're gonna have to book a meeting, the one-on-one. But please, as I was like for last time was very good. So I just want to keep it this way. Please only do that if you seriously want to find out a little bit more, because you have a project or you're intending to go into a project. Please don't just waste the guy's time, because I'm sure you could see that extremely valuable knowledge that you're getting here. So book a one-on-one. So Gabriel, if you could just wrap it in a couple of minutes. So book a one-on-one in the link that I will share. And also I'm going to be picking up a couple of questions. So if people are burning questions, prepare that, because I'm just going to ask you to unmute, but also to speak up. So Gabriel, just please for the wrap up.
Yeah, okay. So what I'm doing there, I'm just showing, I'll be done in 2-3 minutes. I'm just showing how the dashboard is now operating. As you can see here, this is the best case that is running this particular model. And it is on sculpted repayment. And you shall see that if I change here to say, okay, the best case, you can see the best case, we have got about 62% debt to capital, and our debt service is 208. So if I change here, maybe I change it to, you can see there is a fail there. Why? The reason why it's a fail is because of those circular reference that we talked about. Then I just hit the solve button, then to come back to, so okay, now I have high DSCR. Now, in other words, I'm saying the project is of high risk. Because it's a high risk, you can see that the debt quantum has decreased to 49%, right? If I can change again the situation to lower DSCR, what is happening there? You can see it has got the impact of increasing the debt to capital ratio. Why? Because the project is now cash flow rich, it is less risk, and it has boosted the debt service. And look what is happening to the IRR. It is also increasing. If you can check, if I can have maybe a higher leverage, you can see the benefit of high leverage. It can increase the equity IRR dramatically. Then if you can see this graph for LLCR, you can see that the PLCR is always greater than the LLCR. This one was alluded to in the discussion earlier on, that generally, if we have sculpted our debt well, you find that the PLCR is always above the LLCR. So it can work differently. So it can work. You can choose whatever situation or scenario that you want to run in the model. Then you'll be sizing your debt pretty well. Let me quickly go back to the presentation. In a nutshell, that was the case study. Okay, so in this particular one here, I want to go to the key takeaways of this particular presentation. Just to sum up, in this particular presentation, we have seen that a model has a forecast of cash flow generation, and these forecasts are used to calculate the debt carrying capacity. And another key takeaway there is the maximum debt to capital and minimum DSCR are the two major constraints that we focus on sizing debt. So we need to take the minimum of the two. Then the DSCR also allows you to compute the percentage reduction in cash flows before the debt service cannot be met. So this one is a risk metric. It's just a risk metric there. Okay.
Great. Gabriel, thank you very much for your insights there. I think I'm just worried about time. We've got a lot of information to share. I would like to hand over to Tony at this point and check if there are any questions that our audience might have.
Correct. Thank you.
Okay, excellent. So thanks for that, Ritendo. I appreciate that. By the way, Ritendo is the person you're going to have a one-to-one with. So she's the Director of Valuation at Numeris. And for the one-to-one, there are 2 days that we actually allocated for you just to split that, because last time people were saying, I'm not available for that day. Was there another day possible? So there's the 25th of November and 29th of November, which is Monday and Friday next week. So we've shared the link in the chat. So please, I'm going to ask Brian to share that again in case you missed that. That's what I'm saying. If you want to have some one-to-one to go a little bit deeper in some of these questions, please let us know. So otherwise, like I say, so we're now going to be moving to the Q&A. Right. So what we do at this stage, because I think we have about less than 15 minutes, 14 minutes to go, and I want to make sure. First of all, I'm grateful because we still have more than 40 people. So from the 70 we have at the top of this webinar, still there. But I'm sure there's few people that have questions. So what I'm going to do, so Brian probably would have seen some question in the chat, but to go a little bit faster, I like to do is raise your hand, and then if you raise your hand, you have a question, and I'm just going to unmute you and also give you a chance as well to ask the question directly to the person that you want to talk to. So is there any burning question? Don't tell me that you won't have any question, right? Or maybe there was too much of good information, you couldn't believe it. Yeah, so there's also a possibility. So Brian, do we have any question that you could see you would have identified? If yes, because the person maybe stepping up and letting me know. So, or maybe a question in the chat. I know the chat was very active. Let me know, Brian. Did we see something?
Yes, Tony.
Yeah. Okay. Go on,
yeah,
Brian.
There is a question here. I can see Ruben is already interacting with the audience. So one of them is asking, can Numeris handle mining projects? So.
Okay. So who's the person?
That is Pat.
Pat. Okay. I think is it Pat Udechukwu? So let me just unmute Pat. I know Pat actually, by the way. So Pat, I've asked you to unmute if you've seen my request. Okay. Hey,
hi,
Pat,
Tony. Yes, good afternoon, and thank you to everyone at Numeris. It's been a very detailed information. Ruben has answered my question already, with respect to mining projects. I appreciate it. Thank you.
Okay, excellent. So Ruben, and I think if you don't know Ruben, so Ruben is the CEO of Numeris. Ruben, maybe if you can come on camera very quickly just to say a quick hello. People could see who you are. Let me just unmute you as well. So I know you talked last time, but I just want to give you a chance as well maybe to say a very quick hello. So if you can come on the spot. Ruben?
Oh, thanks. Thanks, Tony. Hi, everyone. Thank you very much for following this webinar. I think this is super cool, especially having Chris with us. That was really good. And as usual, with Tony being the orchestra lead in a way. And I think just to maybe follow up to some of those questions I see here, Tony, I think that'll be more relevant. In terms of, to the question of Pat about whether we also cover mining, probably in our presentation, you don't see mining as a sector focus. I think, anything, whether it's mining or any other sectors that is not covered in our presentation, that doesn't mean we will not get involved. I think that, for example, in the case of mining, so long as the developer or the client, follows responsible mining practices, and align with the highest ESG standards, we'll be happy to have a look at it. And that's how we differentiate ourselves, right, as a service provider. So that's very important. So if you have a project which is in a sector that's not listed in the presentation that Randa made, feel free to reach out to us, and we'll let you know if yes or no we can go ahead and under what circumstances. To a question about that Jabu Madlala has asked, what's the cost of their services? Yes, I mean, that's a very good question. And I think it all depends on what's the scope of work. We are a consulting firm, so it depends on what's your scope of work, how complex is your project. So, feel free to reach out to us. You've got our emails in the chat box, myself and Rutendo, or please book a one-to-one meeting with Rutendo, and we'll be happy to understand the scope of work that you have in mind, and from there on, we'll cost it, accordingly, and take it forward. That'll be, how we would normally, do things. It's quite difficult to answer that without any, additional context. I'm sure you appreciate that.
Yeah. So I was just gonna say, there's already 2 people who have jumped to the opportunity to have a one-on-one. So I've just seen that. So a couple of meetings already been booked. So guys, there's only 10 slots for now. Obviously, we can expand and offer more slots if there's a demand. But for the time being, I know the team is very busy, and Rutendo is very busy. But obviously, I've squeezed her just to make sure that she can free some slots. So make sure that you get use of it. Like I say, I think Pat did mention that it's a very detailed information. I very much doubt that you have a lot of firms who are as willing and give you as much information as Mary has done today. So if I were you, I definitely would grab it, before you disappear. So any one last question before we wrap up, because we onto the wrapping up mode, and I want to get some feedback from you as well. Is there any burning question that we see as well? Okay, it looks like Ruben is doing a terrific job going through the question, addressing people concerned, but also I must admit, it was so detailed that it was difficult for people to think of any question because the answer was actually given in the presentation. So any last question or maybe comment somebody want to say? If yes, I'd like you to be courageous, come on the screen here. So raise your hand so I can see who you are, and I can give you your time to shine, yeah? Or if there is any companies who want to do just what Numeris is doing, please reach out to us. We'll be more than happy to talk to you how we could organize such fantastic webinar. Any other question that anybody has very quickly before I start wrapping up? If not, maybe Rutendo, do you have any last final word that you want to share before we move into the conclusion?
Yeah, sure. Thank you. Thank you for the time, Tony. And thank you once again to everyone who's attended this seminar. I think, like you rightly said, we can't cover every topic to the right detail during this platform. But if you use that link, book a one-on-one with us, would be more than happy to sort of share some additional insights. And also, if there's any specific requirements that you're after, any specific sector that you're keen on, we do cover these and would be more than happy to sort of help you or usher you through the services that you need from us. It's been an absolute pleasure, Tony. Unfortunately, Chris had to drop off, our guest speaker, but he also brought in some very good insights, and he was actually quite instrumental in tackling those sort of best practice and industry specific type questions that we had. But overall, thank you everyone for attending. This was a great webinar. Over to you, Tony.
Okay, excellent. So what we're gonna do right now, so with people who are attending, we always want to take your take your feedback to see how we can get things done better. So I'm just gonna launch an exit survey poll right now. Those are just 3 quick questions. What I'm simply asking you, please, I would appreciate if you can all vote for take a vote for it. Yeah, don't worry. So this is not election, presidential elections. Otherwise I would say that I'm the proud dictator of RIA. So very simple. So what is your assessment of the content that we've shared with you today? So did you like it, not like it? Please, your honest feedback is what we're looking for here. We don't want it to be sugarcoating it. If you didn't like it, you didn't like it. That's fine. And we want to see how we can improve it. So what was the content like? So also the format, was it good, not good? I can see, for example, somebody said the format was average as one person, not a problem. So I don't know if it's a sir or madam, please send me an email to let me know why did you, what do you think it was average? I see two people saying that right now. So just let me know, and then we'll see how we can improve on that. And also the overall assessment of the event. So let me know as well. I could see, so a lot of people say very good and good. I think we have almost 90% saying that that's great. So there's only one person so far say average. That's okay. Share your feedback. We look at that. So we want to have the good feedback and also the bad ones, put it that way. Yeah. So but it looks like the overwhelming majority is very satisfied with what they have received from the 20 people who have voted so far. So I'm just going to leave it again for another 20 seconds because I like to collect the feedback, and that's fine. And like I say, while we're doing that, don't hesitate, please, to reach out to Numeris if you like the content. So you want to find out a little bit more, because I know Gabriel was sharing a very interesting model. I'm pretty much sure a lot of you have a number of questions of that, so you can take the opportunity to go for the one-on-one and find out a little bit more. If you have a project you want to discuss more, so the team is there for you to pick up your questions. Yeah. So I'm just gonna stop the poll now. So we're all about transparency here in the renewables in Africa. I'm just sharing you very quickly what the feedback look like. So as I say, so a large majority found it good or very good. Some people thought that there could be some improvement there. Excellent. So the format, again, good or very good. We are close to 90% there. That's great. And the overall assessment of the events, same thing. About 90% say that they were good, and a couple of people say they were average. It was average. Not a problem. Excellent. Brilliant. So that is what we have in here. So I'm just gonna go on and conclude right now, if that's okay for you, guys. So what I want to say, I want to first of all thank all our speakers. Kami, Gabriel, Chris Rotendo, because they've been delivering, like I say, valuable insight. I'm sure you'll agree with me, right? So please clap for them wherever you are. And we talked about debt sizing methodology. We talked about key financial ratios and repayment structure. So we've covered really essential technique that I believe are crucial for anyone who is looking into project finance. And I like to remind you once again, like I said, take the opportunity. The reason we do the one-on-one, because I know a lot of you, a lot of you sometimes reach out to me to say, hey, I'm doing this project, I'm doing that project, can you help? We bring into you the people with the right skills that are able to help you do that. So take advantage of that. And I know some of you say, hey, I don't have the money. Hey, here is a free one-on-one that you can take advantage of. Just do that. Rotendo's made some time available for you, and she's very experienced. Feel free to look her up. You will see that, such as the rest of the team. It's a unique opportunity to receive tailored advice for your project. And like I say, for the moment, we've opened up 10 slots because I think that's what we need. Last time we filled up the 10 slots. Basically, by the end of the day, I had the 10 slot booked up. So please be very quick. We don't mind opening no slot, but like I say, it needs to be really valuable. Please, I'd like you to also appreciate the time of those fantastic professionals. Yeah. So make sure that you do that. So overall, thank you for joining us today. So I'm hoping that you leave it with new knowledge, some practical tool, and to enhance your approach project financing. So stay connected with us with Numeris. So we'll be doing more informative and educational webinar just like that. And I know a lot of people have been asking about getting the presentation. So I'll talk with the team. I'll see whatever they can share, and then we'll be able to come back to you in due time. But for the time being, that's all I have to say. As we've done for the beginning, where we're gonna be leaving you basically in music, guys. So yeah. So thank you very much for that. Thank you for your time, and take care. Bye-bye.
Thanks, Tony.